Mic check. What's going on, everyone? This is Jordan with Conquer Trading and Investing, getting ready here for our public live stream, getting ready to do what we do best, and that is be students of the market, taking the opportunity each and every day to learn, to further our skill sets, and work on towards conquering the markets. We do our best to stay on the right side of the markets. We do a fantastic job, but it requires work. It requires you putting the work in. Today, we're going to be talking about lots of different things. We're going to be talking, obviously, setting up tomorrow's Jackson Hole. We're going to be talking about the market's reaction this morning. We're going to be talking about what our expectations are going to be after Jackson Hole, albeit, of course, dependent on what actually is not only communicated by Jerome Powell, but how the market receives it. We're going to be looking at some interesting market dynamics, including liquidity. And then we're going to be looking at positioning across Bitcoin and Ethereum. And then we're going to be looking potentially at some other, let's say, call the bullish case for Bitcoin. We're going to look at whether or not Bitcoin has bottomed. And of course, none of us know any of those things. We can only evaluate currently where we are right now. As far as looking at if Bitcoin hasn't bottomed and where it's going next, I mean, currently holding a short position on Bitcoin. It is now about 7.5, maybe even since my last 8% profit. So that's irrelevant. It doesn't, if Bitcoin here is going to break down specifically off of, you could see this nice little neat, I don't have my tool set up. Hold on one second. I was wondering if, by the way, if it makes more sense, if y'all could help me out when I get going for the live stream, instead of having the music playing as I get myself situated with the countdown timer, if it's better just to jump into it. So I have all that set up on my own end, but basically I'm not clicking live. And so maybe, I don't know, 15 seconds before we go live or something like that. I don't know on your end, which is actually a better or more preferred experience. If you have the opportunity to let me know, that would be really, really helpful. And I'm glad you're here too. Good morning, Ghost. Good morning, Rashid, and everyone. I hope you're well this morning and doing great. That would be interesting. And also at any time, if anyone is inspired by the content, of course, please go ahead and hit the thumbs up. If you haven't already subscribed to the channel, make sure you do that. We're going to be here each and every morning, putting the work in, staying on the right side across markets, working at the macro. And then at the same time, by the way, if you get inspired for what would make a good title for this particular session and video at any time, please share that as well in the comments. That would be very helpful. Thanks, Blue Magic. I appreciate that. Gene, that's helpful. All right. Jumping straight in would be cool. We got different I want to hear all different opinions, right? You don't have to have the same opinion as the next guy, next girl, or anything like that. Everyone, it's all valued, and it all helps me decide exactly what I think is best to do here. So you could see that, heading into Jackson Hole tomorrow, if I'm bearish on Bitcoin, I could say, well, that looks like a classic textbook on a swing trader's time frame of a bear flag setting up, and a bear flag is a continuation pattern. Obviously, it has to break down through the support. The support of there would lead to further downside. I'm already positioned for it. Again, holding a nice, comfortable position up over 7% going into the news event. And there we go. Let me go ahead and pull up the brush as we get going. Straight grand rising class. Great morning, everyone. Ghost, we got to do the honeymoon yesterday. It was beautiful. I'm just pulling up as we get going over here, getting comfortable, right? Because we're going to go ahead and put in the work over here and put in a nice session together. Entering ghost mode, and then we're good to go. All right, so I want to come back to that. It's not what I want to start off with, so I want to jump back to that in a little bit. Let's just make sure that we all understand tomorrow at 10 o'clock a.m. Eastern Time, we have Jerome Powell, Fed Chair, giving his speech at Jackson Hole. Market expectations are that he's going to come off hawkish. Now, it's a different let's say what matters is not if he comes off hawkish. The market already expects that, right? So do you think it's priced in, or do you think he's catching anyone off guard? Now, at the same time, if the market doesn't buy it, and it doesn't buy it for a whole litany of factors, and then even though he comes off hawkish, and then price action is what matters, that right there is what we have to pay attention to. That would be a big signal. By the way, taking a look at the NASDAQ as we're getting into there, so far, as we've done here on these morning live streams together, right, everything is falling in according to plan. Now, we did expect for price to bounce off these lows over here and just kind of get ready over here for the next bit of news, which is going to be whatever happens tomorrow in Jackson Hole. We have over here, this green line is the support, the red is the resistance. Right now, either you are short over here. Again, we talked about smart money. If they waited and didn't sell this rally the whole way up, which a lot of people who got tied down, bogged down into their bias, it might have been because of all the engagement, like talked about yesterday, that bearish, doom gloom is all the rage right now. And maybe a lot of people got locked into their bias, and a lot of people who did very well on certain portions of the market, they gave back a lot of their money and got themselves into a hole. But smart money, they would have been selling down over here if they wanted to take a position. That's not what we were doing. I was very clear about that Monday and Tuesday. I was looking at a bullish structural breakout of a descending channel. That has since been nullified, and therefore no man's land. And we're waiting for what happens next. Obviously, taking a position on a Friday after Powell, that's not something you want to do, right? By the way, who's trading each and every day off the cuff, right? What does off the cuff mean? It means that you don't have a well-established, thought-out plan, and you kind of go off your gut, you go off your feelings. For many, it's part of the learning process, right? That's how you gain experience in the markets. It could be quite painful like that. Don't trade tomorrow off of a high impact news event, especially off of the market reaction for it. You're better than that. You're going to get, even if you don't wind up putting on a bad trade tomorrow, over time, that's how losers trade. You want to be a winner. You want to be methodical. You want to have a plan in place, whatever that plan is, and you want to execute on that plan. Watch out for any type of whipsaws, right? If all of a sudden, for example, Powell was to come off overly hawkish, and then the market initial reaction is all of a sudden selling off hard, and then sometimes you have, a lot of times during FOMC press releases, right, when chairman is speaking, he'll say something else, and then boom, it'll go the other way. Or it could go, all of a sudden, it could come off very dovish, right? We could come up, and then boom, take the floor out. Be very careful. Tomorrow is a learning experience for the larger view. It is helping us discern what our positioning is likely going to be until next Friday's non-farm payrolls, and then also into the CPI the week after. And this morning we had some job numbers, right? Initial jobless claims, resumed uptrend, right? No one can find out what's going on. And does that give the opportunity to the Fed, for the Fed to continue its hawkish stance? Potentially, what I think is going to happen, thank you for that, my friend. Thank you so much. What I think is going to happen tomorrow, my own personal belief, is that Powell is going to be able to walk a fine line between hawkish and dovish. He's not going to come off dovish. He's going to try to just walk a fine line, and reinforcing the very fact, which is true, that right now we are data dependent. And that means that each and every data release that we have over the next not only month, going into September's FOMC, but also in October, every single one of them is really important, because that's what's affecting policy going forward. If he's able to do that, if he's able to keep the market guessing, that's a win for him. I personally do not believe that he wants to create a cascade. I don't think he wants to come off very strongly hawkish to go ahead and cause all of a sudden people that are already positioned overly short to go ahead and lean in harder to bring down the markets. And it's not so much that he cares about the price of the S&P or the NASDAQ so much as the credit markets. And I think that they understand that they're getting towards a very fragile place where actually things could break. They don't want to hasten that effect because their only solution, if and when things do actually break, is going to be to go ahead and restart the printers, balance sheet expansion, security, quantitative easing, security purchases. That's all they could do. I don't think they want to do that because the end result of that is a loss of credibility as well as a further inflating of the money supply. So I think what they're trying to do is buy as much time as possible between now and then. And if they could push that out into 2023, 2024, that's much more desirable. They're trying to buy as much time as possible. So with that being said, I just want to talk about this briefly. Arthur Hayes, one of the founders or a founder of BitMEX, and he's got himself into the macro game. He likes to follow a lot of people that he believes offer signal. Amongst them is Felix Zulauf. I believe I saw a long time ago a really nice interview with Felix on Real Vision over in Switzerland. And it was kind of nice to get to know him, to get to know the lifestyle he leads and his thoughts on the market. And basically what Arthur is saying that, look, I subscribe to his newsletter. It's expensive. He often doesn't put out content, but what he does, it's entirely worth it. It's quality over quantity. And one of the things they're touching on is something that I'm raising my hand, have been very vocal about going back since April and May. That's a long time here. As your favorite podcaster has been telling you and expected by now that the Fed was tightening because of inflation until things break, and thought by now that things have already broken. I mean, you could go back to May and they thought by then that things should have broken already. And I've kind of tried to just look at the markets with my little experience and say, you know what? I feel like that there's an excessive amount of liquidity out there. People are talking about there being liquidity issues, but I don't see that. And I've pointed to the New York Fed and the reverse repo. And if you go back to 2018, right? And then this is when the Fed started raising rates and tighten them over here. This is when quantitative tightening was running, right? And then it was in December. You see how the liquidity got sucked away as quantitative tightening started? And then you could see over here, there was problems. The reversed repo market broke. The overnight rate spiked high, and that was the end, right? And when I say that was the end, what that meant was that balance sheet expansion started, not outright QE, but the balance sheet was growing at this point. Risk markets were taking off. Risk markets were taking off, by the way, from here to that December 2018, right? Up until things broke in September. Risk rallied to new all-time highs during quantitative tightening. Now, there'll be some people who point out, well, things were different back then, that you had Japan and you had Europe running the printers. Seems to me that they're both running the printers right now as well, huh? So what else is different? Well, at this time, as quantitative gets ready to start, right, next month, program to pick up through November. And I mean, obviously, people talked about the taper's vapor. That's not possible. They can't taper a Ponzi. Well, they tapered it. And even as they were tapering it, people were like, that's not possible. It's fake. It's not really happening. No, it happened. And then not only did it happen, although the quantitative tightening program just started, they're not selling securities. So they can't force how quick they have to wait for maturities in order to roll them off the balance sheet. That picks up starting next month in September, and that will continue getting, I think, up to where they want it to be by November. Now, that's all variable. We can't really look at too far in advance. I guess we got a bit of a macro focus here this morning. On Tuesday's session, in the opening monologue, we also had a lot of macro-based stuff. Yesterday's session was a lot of chart-based technical analysis. I want to get into the charts, but this is what the market is showing us right now. So I want to focus in as a student of the market. If you enjoy the content at any time, please go ahead and smash the like button. If you're not already subscribed to the channel, please go ahead and do so. Absolutely, my brother. Thanks. Absolutely. So what we're looking at over here is those things did happen. You're seeing the balance sheet come off ever so slightly, but expectations are that's going to pick up. But there's a lot of excess liquidity out here. Now, the only thing that could take this away and very quickly would be like some type of catastrophic event. If Apple all of a sudden imploded, the reverberations throughout the financial markets because of the bondholders, and that would dry up this liquidity in a heartbeat. But outside of some type of crazy unexpected event, and how many crazy unexpected events have we already had? By the way, did you notice that Germany, undergoing massive inflation, undergoing, all the effects of the war in Ukraine, their GDP came in and it was at 0.1%. That's quite impressive. The reason I bring that up is because when the Federal Reserve Chairman Powell has talked about that he believes that the US economy is strong enough to withstand this tightening, I really think that they mean that. Now, I'm not saying that all of this tightening is not going to lead to something breaking in the future. But I want you to understand when the last tightening cycle began, early December. I'm sorry, it really began earlier than that. But all through 2018, they were raising rates all the way to the end of 2018. December was the last rate hike. Quantitative tightening is happening during this period. And yes, risk markets, especially in the fourth quarter 2018, really came under massive pressure. And then they paused rate hikes. They didn't come out and say, we're pausing rate hikes, and then the market rallied. They raised rates, and the market knew that was a policy mistake. And from then on in, the markets rallied. A few weeks later, the Fed verbally pivots and said, you know what? We're actually moving towards more accommodative stance. And that's when they paused. But the market rallied way ahead of the Fed's verbal acknowledgement of it. And quantitative tightening kept running. And things didn't break. Not even when the reverse repo market broke. That was a quick fix. The Fed just started expanding their balance sheet. Risk wasn't even affected. Things didn't break until over here in March 2020. That's a long time. 2 years is a long time to get that wrong, right? Similar situation right now. Again, as they begin that tightening cycle, we're seeing risk come off massively, right? Bitcoin off 75%. All coins obliterated. Tech obliterated, right? NASDAQ off substantially. S&P 22%. Risk has been getting hit and hit hard, right? But are we getting towards the end of that cycle? Look, a lot of people have been telling you that things are going to break. I've been telling you the whole time, I don't think things are going to break. I think everyone's timing is wrong, and timing is everything. If things are going to break, right? First of all, that all escalates very quickly. Hopefully we'll be on the right side of that. I can say, and it's all on video here on this channel. You go back to the early videos in late January 2020, from the very top, riding it up to the top, was able to get when the markets began their descent and actually were crashing late February into March, and then not only catch the turn, but ride the turn the whole way up. Right? I don't know that could be done again if something like that develops. It's not right now. I think that there's ample liquidity out there. And what Felix, let me go ahead and share this link for you just in case anyone didn't see it yet. What he's saying, it's not so much about the rate. It's about how much money is out there. He also believes, because of the size of the Fed's balance sheet, because of the reverse repo, and because of the amount of the U.S. Treasury general account balance with the New York Fed, this is something that has come up. I haven't really honed in on it. It's only been mentioned, and it's only been mentioned when pointed out by Zero Hedge. By the way, I personally have read Zero Hedge for, over 15 years now. And the way I read it almost daily, and 99% of it's noise. 99% easy. But that 1%, if you're able to distinguish between signal and noise, is an absolute invaluable education, but you can't rush it. It takes time, much like these sessions we do here together. If you're looking for a market education, I am more than happy to share with you what I've learned over these 24 years. But it's not something that you could be done in just one session in one day. It takes time and it's accumulation of knowledge. What I often do is just read through the headlines. And then if anything, I decide, like that's how you filter out the noise to begin with. And a lot of it's noise, right? But then you could hone in on some things that are very important. I was going to go over with you actually right now and show you how I read headlines and how I am able to use that ability given to us of critical thinking. But we're not going to do that right now. We're going to continue over here with the markets. It was only a few times that I mentioned the U.S. Treasury's account balance, and that has been off of the layup from Zero Hedge. When they were displaying that to me, and they were showing to me and teaching me. So that's not something that I've honed in on, right? But it has been mentioned. But again, only when Zero Hedge has mentioned it. So there we are. And the only reason I'm focusing on this, because I think it's important. I think it's a lot different than the, I want to say narrative. That's a really bad term. That's not a narrative. The general consensus of analysis. Most analysts are really good at explaining and articulating things in such an attractive way. But what they're doing is explaining what the general belief is right now in this moment. You got to be forward looking. If you're an investor, if you're a trader, you have to be able to be processing everything in real time and seeing what's going to be happening in the future. And right now, it's starting in June, I put out that video, the macro could change rapidly. I said at this particular point, we now have to become data dependent. It was in the next meeting in July that the Fed Chairman Powell said the same thing, that no more longer do we have forward guidance, that they are now data dependent as well. And that's where we are. So I can't give you any type of expectations of where the market is going to be at the end of the year or in 2023. I have my ideas, but I can't. We have to follow what's happening. That's all. Boom. There you go. Maybe shorten that up a little bit. That's a good compromise between everyone. I like that a lot. All right, let's get going. Good article. I haven't gotten past these first 3 bullet points to even read it. So, well, is there a lot more? And I will myself, but I guess I really feel the need at this point. What else? Let's start off over here with NASDAQ. Are we kind of on hold? By the way, we also talked about what was different back in 2019 as quantitative tightening was undergoing here, was that, or some people bearish in the market point to both the printers in Japan and the EU running, but they're running again still. They are. And then we look at China overnight injecting $130 billion into their economy towards infrastructure in response to their whole real estate meltdown. I don't think that will be their last action, and it's coming right now in piecemeal. Is that why we were seeing the market a little bit, let's say, lofty today? Or you could see risk leading, Ethereum up, outperforming yesterday, right? Did you notice? This is a very important observation. By the time we were live here, did you notice that like both Bitcoin and Ethereum at that point were up more or less about 1% on the day, but Bitcoin was outperforming Ethereum, and then they gave up those gains later in the day, right? So was that like any affirmation of any type of risk being on? Today is more, it looks more like risk is on with Ethereum outperforming Bitcoin here to the upside. And want to point out to you, right, why most of us, you could look over the last 10 years, look at the risk markets, and they have been for sure straight up and to the right. And that's been ingrained into a lot of us. I know a lot of people are calling for potentially the everything bubble to have popped. There are a lot of people out there who believe that there is one more or two potential massive expansions of the balance sheet in the Fed coming up in the next, let's say, few to several years. And there are more impulses left. There's a lot of people out there who believe that from where we are right now, that price is going to go on to make new all-time highs into 2023. and then the apocalypse is going to happen as the market, drops its bottom out and goes down. Look, all those possible scenarios could happen, but the truth is we don't really know, right? I want you all to be prepared though for different scenarios, and just a little perspective. If you go back to the decade prior, right? By the way, it took price over a decade, this is on the NASDAQ, to return to a new all-time high, right? Now you could take a high performing, let's call it an asset like Amazon during that period, right? And Amazon was able to make the new all-time high a little bit quicker than the overall index, right? It took about a decade for Amazon to make a new all-time high, right? By the time that the NASDAQ itself was able to do it, Amazon has gone off to do pretty spectacular things. Is it possible? I'm not trying to, but I am making the comparison here. Is it possible that, first of all, that we enter some type of, decade that's not straight up and to the right? I mean, look, my own personal belief, it would probably be something that it remains as it is. And a lot of people have seen the gold chart with the German marks, priced in German marks, during the end of the Weimar Republic, and it was very, very volatile to both sides. In hindsight, once it ends up imploding, all of a sudden those reverberations don't look as bad. Actually, I posted on Twitter yesterday a post talking about, in my opinion, the current deglobalization is going to be inflationary, but there are waves of that inflation in between. And it looks like this, right? And you have to be able to understand when you're at a peak and when you're at a trough. And right now, my own personal opinion, or the way that the market has been lining up, is that we are at peak. I call it a near term or interim, and I'm talking about inflation, right? And a lot of people at the very peak is when they started to embrace the long commodity trade. Here on CTM, by the way, it was in 2020, June. I remember when we talked about the breakout of the commodity index. Now, that's fine and great, but listen, if we would have had the foresight at that particular time to understand the changing dynamics of the world, due to obviously, first of all, the expansion of the money supply, the lockdowns, the trade war that was occurring specifically with China and the US, and been able to understand that that is not something that is to be traded. That was opportune time for positioning. That would have been spot on. Obviously, that's not what happened. I like this better, coming down and up to the arrow. That would have been spot on, but that I'm pointing it out. I'm always trying to do better, and I'm always trying to learn from mistakes. And getting a good entry is not a good thing if you don't manage the position correctly. All right. So, and by the way, not being hard on myself or anything like that, I didn't have the capacity to understand those things at the time. I think that we are in unprecedented times. It's a new paradigm, and I don't know of many who had the foresight back then to be so forward thinking. And I imagine much of that is happening right now as we move forward. I don't know how many people have a true understanding of really what the world looks like 5 years from now. We have to do our best to try to continually be open to all different forms of opinions, and then weigh them to the best of our ability to make that larger, bigger picture. So, by the way, is it entirely possible that why I doubt we see anything remotely close to what we saw during the dot-com bubble bust into the Great Recession? Is it possible that markets, go sideways and not straight up and to the right, or something more along the lines of this? Yeah, I mean, look, anything's possible. And although we're accustomed, and you're accustomed to much more of and you can see over here, you see the radical moves that are occurring when I just talked about right? Is it possible that we see big wide swings going forward? And they are up to the right. That's kind of what I would imagine is going to happen. Now, the degree of those swings, I don't know. This one could come all the way down, even take out the lows of the COVID, and then all of a sudden spike up, come back down. I don't know what it's going to look like, and I can't imagine that anyone has a crystal ball and will be able to. But I think that, first of all, setting your perspective that you honestly don't know what is going to happen, that's a great foundation to build off of. That's going to give you a much greater advantage than just coming in and saying, well, from where we are right now, we are coming up to make new all-time highs, and then we're coming down and boom, and who knows, or that we have one more leg down. The market's going to make one more leg down, and then it's straight up and to the right. And when it comes down and Bitcoin goes down to 12,000 or Bitcoin's at 3,000, I'm buying, and then I'm just sitting back and I'm going to watch what happened to all of you who were not only smart enough, but also, let's say, had the foresight to go ahead and lean in hard when that happened last time, and then price went like that. Yeah, look, I could say as someone who did it, I'm not expecting that to happen again and look like that. If it does happen again, I hope that I have the ability and the foresight to be able to lean in and do it again. There was a big difference over here. Speaking of Arthur Hayes, founder of BitMEX, BitMEX went offline over here. It caused a massive liquidation loop feedback and just price went down so far so quickly. To me, it was like, that's not sustainable. Same thing if price was just shooting straight up, like it's not sustainable. And it was more like that was like a close your eyes moment and lean in. There was nothing easy about it. Same thing if Bitcoin comes down to $12,000 or $10,000 and you think right now you're buying, well, wait until you get there. You're going to be thinking, you're going to be hearing Bitcoin's going down to 3,000. That's a big difference, 10,000 to 3,000. Or you're going to have the fortitude to step in there on the bid, or are you going to be waiting for 3,000 at that point, just continue lowering your bet? And then, there's nothing easy about it. Let's start there. There's nothing easy about it. And if you understand that, you're going to have a much better time trading the markets, right? Having that humility. And I think when I talk about during these bull market phases and everyone's an expert phase is going to be over, that has many different layers of meaning, right? Including your favorite podcaster really doesn't, like he's out there trying to figure it out. But when you come off as an authority without putting out the qualification that you really don't know and you would like to, there's a big difference. Yeah. And what I'm talking about over here is right now that, there's a massive amount of liquidity out there. I just pointed it out to you looking at the reverse repo market, right? And people have been saying, oh, well, I think that, we're going to have a liquidity crisis any moment. Here we are 4 months later, and we haven't had a liquidity crisis. Yeah. If they're going to tighten, if you held on to the meme, tighten until it breaks, you have to understand last time that tightening until it broke was a long time, right? And timing is everything. Timing is everything. So tomorrow we get a next bit of breadcrumb information about what happens next, as Fed Chairman Powell either gets to affirm that truly they believe inflation continues to be out of control, and even though that they know that they can't do anything to change the supply side, they could do what they can on the demand side, and they could go ahead and they could try to put everyone out of work and cause a recession and loss of jobs in order to go ahead and pacify that demand side. He could say that, and then if he says that, I expect a sell-off to ensue. Whether or not we're able to take out the current lows, no one knows. That's a guess. We'll do our best to lead into our technical analysis skills and to figure it out. Or the market might not buy it. That's a huge signal if the market doesn't buy it. We want to make sure that we're prepared for that and ready for that. I think what happens is that he walks a perfect fine line between making sure not to come off dovish. He came off dovish at the last press conference. Market began, a lot of shorts began covering, rightfully so. And retail took the ball and ran with it. Retail ahead of the professionals, which has been for quite a while now. Again, coming back over here to our most recent history. And when you look at the last crash over here, right? The professionals, right? They kept telling you they were positioned for
to see another crash the whole way up. It wasn't until the summer of 2021 and coming out of it that people into the fall that people really began to understand that this was for real. Retail led the way the whole way. On the way down, retail has been doing fantastically great. And at this point in time, retail was way ahead of the pros once again. I attribute that to the internet. There's much more information out there. There are communities like this where we have the opportunity to work together and learn from the markets, from each other, from ourselves. And there we are. Yeah, I mean, a lot of people will be, but do you think that do you think my bids won't get filled before yours? So that's crypto, because maybe I'm bidding up at 12K. You know, I would love cheap Bitcoin. There's no question about that. Hey, it goes down to 3,000. Woof. Can you imagine how much I increase my stack? But is that your plan? I don't know if that's a good plan. What would be a good plan? I mean, do you have a plan? I really wanted to talk about that with all of you today, and just to get you all to figure out what your plan is. How, like, I remember early in my career, there were mentors out there, and they were very, let's say, always pointing out the importance of having a plan and strategy in place. So sometimes my plan was like, all right, I'm not gonna, I mean, that's not true. My first actually trading strategy, if anyone is interested, is in the stock market. This is going back into 2000 and I think it's 2002. It could be 2003. And it was a really good system. It was off the 5-minute time frame. I had two moving averages. No, I'm sorry. It's been a long time. We're talking over 20 years here. I used the 4-period EMA. And when price was, I looked for stocks, first of all, doing a scan. I'm sorry, this is me being a little bit nostalgic. I looked for stocks that were in the top 20% of earnings. And then I looked for stocks using for trend. What was it? Is it someone help me out? Is it the DXI that had over a 25 showing that they were in an uptrend? Looked for stocks that were in the top 20% of earnings. And then when they pulled back down below 5% off of the 4-day moving average on the daily time frame, then I would jump over to the 5-minute, wait for a moving average crossover of the 3-period and the 12-period, and then I had a stop loss at X% and a profit. And it was a working system. It really was. It was a good one. But for a while, I would think a plan is something like, all right, I'm only taking X amount of trades today, or I won't trade between these hours or anything like. If your plan is just like some type of loose idea and it doesn't include exactly when you're entering, exactly when you're exiting, if it doesn't include position sizing, if it doesn't include position sizing off of that particular risk per trade, you haven't even begun to develop a plan. And instead of actually trading, do not trade at all. At all. Spend time each day. I mean, spend 30 minutes a day thinking about developing a plan, and then start paper trading that plan, and then work at fine-tuning and developing in that plan. You're going to get way further than if you just go out there and you're trading off the cuff. You're not gonna win money. You're not gonna gain money. You're not gonna be constantly profitable if you're doing it the other way. You might have some good streaks, and then you might give it back. I had good streaks doing it like that. I was able in 1 year just trading off the cuff, going crazy. I was trying to beat Larry Williams' record of almost 11,000% in 1 year. I got up to like 5,700% in the year, and then gave it all back. You know, you can't trade without a plan. You can't, no matter how good you are, if you trade discretionary like that, you're not going to get anywhere. Yeah, 20K. That could happen very quickly, obviously. And we got some good important levels down over there. I'm just going to zoom out over here. I mean, 20K, look at that.
what's really cool about that, you could see the little bit of support. Like you could see that was resistance after it broke. You could see that like tested as support. Come over here. I could see that's a big area of support, and a test of 20K. That could even be, I mean, you a nice fake out. You have a breakout of this bear flag over here, right? And that would pretty much be the expected target of that bear flag anyway. Catch that little bit of support. We've seen past bear markets actually bottom somewhere similar in a similar fashion, coming in and testing that, and then boom, that might wind up happening. But I have no idea. A really good and simple way, though, for you to know whether or not you are on the right side over here, right, is we'll try to do this daily, right? Show you positioning here. Like on Ethereum, are you in an uptrend or a downtrend? This is on the daily time frame. This is for people who don't have the opportunity to spend a lot of time with the markets. Maybe someone has maybe let's call it, 10 minutes a day or an hour a week or 30 minutes a week. You want to be on a higher time frame like the daily, and this is going to help you understand what side of the trade to be on. I'm talking about the daily side over here. Now, the 8-hour over here, this also provides some really strong signal, right? Imagine if you're able to, what is this? This is from 2021, right? 478% return. It's not bad. I mean, it's not like what we do. When I say what we do, I'm talking about CTM. CTM since 2021, 1157% return with a 23% drawdown. But don't try to confuse something like that with, something that is outstanding for a general market. Have you done that since 2021? Had almost a 500% return, 36% drawdown, or are you actually just holding on to a position and it's just, but you didn't know what side of the market to be on, right? So don't discount that. It's pretty impressive as is, and we'll make sure that everyone is able to know where. And right now, that's what, right? Well, long on Ethereum and long ever since July when we had that really hot CPI. Now, again, I don't want to be I don't want to be conflicting. I'm personally currently short Ethereum right now, right? Hold on one second. I'm personally currently short Ethereum right now, but I'm very active. Not only am I very active, I have this all automated, right? So it's a little bit different. All right. What about Bitcoin? Let me jump down over there. I'm getting a little confused over there with all these tabs and windows. Bitcoin, a little bit different, right? 8-hour, you should be short right now. Right, that's pretty good. Bitcoin didn't have, by the way, in that last run up, the same oomph and the same momentum. You can see it over here in the daily. Or how about this? I know a lot of people, lots of friends, lots of family who want to know when they should be in and when they should be out of Bitcoin. This right here, the perfect opportunity. We will get into a lot in the sessions ahead. And with both of these, right, we'll help you on a regular basis know what is a good place to be in Bitcoin. When that's a little bit different, right? 82% since 2021. I mean, look, it's a lot better than someone who's just been holding on to Bitcoin, right? It's not what we're doing here together, right? Which is a little different on Bitcoin. Jumping around here trying to find where we are, right? That's only since 2022, so I'm not going to go back and show you right now, maybe tomorrow. Let me jump over to this chart though really quick. A lot of people have been talking about they are unable to find any similarities between this current bear market and past bear markets. I want to go ahead and show you like this. Let me actually take off the most recent one. We'll go back like this, and a lot of people, Root, by the way, Rational Root, big shout out. We've had him on this channel a couple of times. We were the first one to interview the Root. And we talked about how, for many different reasons, the structural top is in April. Whether you're looking at something simple like the RSI, whether you're looking at the euphoria that took place, whether you're looking at almost every single on-chain indicator, whether you're looking at, by the way, big shout out to Rick
talking about Bitcoin priced in Indian oil, or the Hang Seng, the Chinese stock market peaking over here. Lots of almost every single except for price. Price made a higher high in November. Outside of price, almost every single structural indicator points to April as being the top. And if you line up the past bear markets, all of a sudden you do start seeing some similarities. One of them is in the last 50 days, price came off 50% capitulation, right? In the last 50 days, price came off 50%. Now, I'm not actually trying to bring it up there and I'm just giving you rough sketches here. Yeah. And then over here in the last 50 days, price came off 50% again. Now, I could see actually from this view lots of similarities between past bear markets and this current one. And again, this time is different, Jord. Why is it different? Well, it's different because we're in a recession. It's different because the Fed is tightening. Oh, you're telling me over here in 2018 that the Fed wasn't tightening, that quantitative tightening wasn't running? You're telling me that quantitative tightening wasn't running as Bitcoin did a 4x over here? Yeah, all that was happening. Well, it's different because of inflation. The Fed this time is doing it because of inflation. Okay, but inflation right now, it seems to be that it's peaking. Now, I admit, I think it's sticky. I don't think it's going away. I don't think that prices are coming back down, but I do think as measured month over month, year over year, especially year over year, it's going to start coming down right now. So we're looking at what I view to be a peak of a wave. Now, how soon that next wave comes in, I don't know. I'm data dependent. If all of a sudden I start seeing commodity prices, oil, food related commodities rising, at that point, that wave is going to come up a lot sooner. But if those things don't start rising, then maybe it's a near term to immediate term peak, and maybe it's going to take, several months instead of 3 months, and or maybe longer. I don't know, but I do think that it comes back up. But trying to time it in between, that's everything. And that's what I want to get done with you and make sure that we're able to stay on the right side as this all develops. One important thing you're seeing over here is wheat prices, right? Food. We're seeing all that Russia and Ukraine, the two bread baskets of the world, and a bunch of grain was able to get out. Now, the problem may be next year. And I often talk about why I personally see the opportunity here setting up a major risk rally. How long it lasts, I don't know, but I'm concerned about what could happen next year, and whether or not, because that's the deteriorating economy. We're seeing housing prices collapse this month. That's something that's going to probably take a while before it is able to also revert backwards. You're going to see things like people continuing to lose their jobs. That it's all like a big domino, right? And a lot of people may have kind of front run everything they expected to unfold, but got the timing very wrong. Next year could be a big problem because as this war is taking place, I don't know how much grain was planted for next year. That's something that we just don't know. By the way, this is concerning, talking about reading headlines. Now they're talking grain traders see record profits amid food crop, and they're calling for a windfall tax. Do you think one day there might be a windfall tax for crypto traders? Huh? Here we got grain traders. A lot of these grain traders, what are they doing? They're farmers who have been just simply hedging their own personal crop, right? And now all of a sudden they're going to go ahead and tax. This is signal that in the future, governments, as they just hired a host of new agents, Mr. Smith, arming them that taxes are going to be, people are going to just be taxed and taxed and taxed. That is the fall of an empire right there, by the way. And I don't know that we're looking at any type of fall of the empire. When I talk about the empire, I'm talking about, the United States. Seems to me that in this deglobalized world, being resource rich, being talent rich, that being tech rich, as you're starting to see manufacturing move back to the mainland from overseas in that globalization world, the next 5 years may look a lot different. I personally believe the United States is going to be positioned very, very strong. It may also be a new type of renaissance of sorts, not a cultural one, more of a technical one, one of manufacturing one inside the U.S. So, what else? What else are we looking at here today? Yeah, that was a big deal. September 2019. Yeah, that was a big deal, and I remember that day I sent out to my family a message, and I let them know that the crisis was beginning. Sure enough, right? How many months later was it? People don't understand. Like and this is most people, but I remember family comidas, and I'd be talking about my view of the markets and the world, and people would just be like, "Come on, the peso's always going to be here." Oh, what happened in the 90s in the tequila crisis? Wasn't it devalued? And how many times has it been devalued? A few years ago, wasn't it devalued from a 1 to 12 pesos for every dollar to 20 pesos for every dollar? Do you really believe that? Well, I don't like to think about those things and do those things. And we were talking about, okay, then when that happened in September, I was like, it's happening. The crisis is beginning, right? And then people go back to their normal routine. They watch the TV, they forget about it. What happened 6 months later? 6 months later, the world financial crisis, world imploded. Now that time they were able to go ahead and just as Powell put it, just flood the system with money, just print dollars. We don't print them. We just hit the keyboard, right? Now the next time they try to do that, it's going to have a diminishing effect. It's going to, first of all, do you remember back in 2008, it was $850 billion. Well, that was such a large number. It was so hard to wrap your head around. It really was. And then fast forward 12 years later, it's 4.1 trillion and then 1.2 trillion dollars for the next 2 years afterwards. What's the next expansion going to look like? The next time there's a crisis, do you think they're in a rush to break things? Do you think they want to go ahead and have a $12 trillion expansion of their balance sheet? Do you think that's going to go over well? Or do you think that maybe they are trying to engineer a soft landing? Now a lot of people, they get caught up in terms and definitions. And for some people, they may say, well, a hard landing is we enter into recession. Okay, then odds are we're heading into recession. And whether or not you choose to define the current economy in a recession right now or what's to come next year as a recession, I'm choosing the latter, right? That's probably inevitable. It would be a miracle not to go into recession. For me, when I talk about a hard landing, and I most likely have my definitions wrong here, right? But what I'm talking about there being a crisis. Now, a lot of people are under the assumption that the Fed is going to tighten until something breaks, right? And what I'm getting at is I think that they're going to be able to tighten without something breaking, systematically breaking. There's a massive amount of liquidity out there. And by the time something breaks, they'll have been able to claim victory because it's not going to be today or tomorrow. Now that could change, and I'm waiting for that to change. But everyone who was under the assumption and impression that that was already has happened already, it's been a long time. That's all I'm trying to say. Yeah, that's a bear flag on Bitcoin. That's a big bear flag happening on Bitcoin, right? You could see it very clearly over here, and we're positioned for it. I mean, so by the way, coming off some good trades over here. When I say good trades, I'm talking first coming into June, and then on the upside over here throughout mid-July into August. I don't expect this current trade to even to end in profit. I personally, only one out of every 3 trades I take even goes into profit.
right? So I don't even I just had some good wins. So I go into the trade. The trade was 10% into profit, now only 2% into profit, but I'm completely detached. I don't even care, right? I don't even care. And if I cared, I don't think that I would be able to, and probably, 10% into profit, let me go ahead and book that, right? Then same, there's no way I'm booking 52% over here because I would have exited. I can't buy the bottom and sell the top. I'm just trying to get the middle point, the sweet spot of the trade. And I'm not trying to get it each and every time. I'm trying to get it over time. I know that if I am systematic and methodical and take my own personal discretionary ability, that's not the words I was looking for. But if I'm just trying to trade off the cuff, it's not going to work out as well. There's no question about that. And when you put in those trades, all of a sudden, man, they start to compound and compound very, very big over here. Coming back over here, just looking at 2030 and 230% in 2022. I mean, right off that long side, 52% gain, loss, right? I mean, okay, small gain, loss, loss, small gains, small losses. That's the whole idea, and that happens the majority of the time. Do you have the fortitude to do that? Nope, you probably don't if you don't have a well-developed plan. Boom, small loss, small gain, small loss. Nice size gain, small gain, nice size gain, small loss, small loss. Nice. The short side was great, right? The short side was great, but the long side, it's in your favor and even better. Anyway, I'm going to get to work over here this morning. Before we get off, we're a little light on likes. I don't know what's going on over here with the 10-year. If you have the opportunity, if you enjoyed being here, if you enjoyed me sharing my time with you today, please go ahead and share the live and go ahead and smash the like over here. I don't know what's going on with the 10-year and whether or not I think that we're going to have a lot further direction after tomorrow. And unfortunately, we're in that position a lot. What do I mean by that is you're going to hear me 3 weeks from now as we get towards the next FOMC meeting on that Wednesday. Monday and Tuesday, I'm going to be like, well, we're waiting on the Fed. And that's the reality of the situation. The central banking system is the system that we live within. The Federal Reserve runs the show. We are dependent on what not only is, the meetings that happen in secret and the policy that is set forth, and make no qualms about it. Their policy ever since inception in 1913 has been to redistribute wealth, to take money from the population and redistribute to that it's not even the 1%, that 0.1%. That's their goal. That's what they do, and they're good at it. So people think that the Federal Reserve, they're masters. They are absolute masters. But we are waiting right now to see what happens, not only tomorrow, but what the market's reaction is tomorrow. We're going to go ahead and make sure we put in a good session tomorrow morning, take a look at what's going on, and then are able to make sure that we stay on the right side. The dollar also over here, right? That looks to me, if I were to say, and probably all of you, I could say, well, that also looks like a bull flag. We got on Bitcoin, on Ethereum, we got a bunch of bear flags set up over here. That's a weird looking bear flag. I don't know if that's a bear flag. But that looks like a rising wedge. And usually how that thing breaks down is also like this. Yeah, so we got a sharp rising wedge on Ethereum. We got a textbook bear flag on Bitcoin. And on the DXY, we got a nice bull flag. And all of those are continuation patterns, and expectations are that they continue to the upside. Now, doesn't always happen like that, right? This is a nice uptrend, though. A very nice uptrend. Coming back over here, you can't say that, well, it's not a bull flag, but let me just draw it in and just show you to make the point, right? It doesn't mean that you break out to the upside, right?
often when you have descending channels that are wide and they come in and this is coming in to test the resistance right now. It's not testing the support. And they come in. That's when if it fails, that's when a big move down happens. So here's the thing. As a trader, here's a takeaway. As a trader, you don't need to predict the market. This is like you could have a system and your strategy could be trading wedges and flags. It would be a good system. You could do that very, very well. You could develop a strong system simply around trading flags and wedges. And it doesn't matter if it breaks to the upside or it breaks to the downside. Regardless, you're able to manage your risk off of it and develop a system. So it's not a question of trying to say, I expect price to break 110 or go back to 105. How and why would you even say anything like that? It's when you get a breakout from any type of chart pattern, being able to go ahead and not like, first of all, count on being successful, but being successful, how you manage your risk off of it. As I just showed you, the majority of my trades are losers or small winners, right? But most people, they have the need to be right ingrained within them when it comes to the markets, and therefore they think that they want a high winning percentage. Anytime you see someone who like goes like this, you ready? I'm gonna draw like you got. All right, I'm gonna just pretend that adds up, okay? And they draw a line over here, and then they're like, all right, and then the target is gonna be like, if that breaks down, is over here. Hold on 1 second. Let me draw it in beautiful for you. All right. I got a target right there, and you know I'll put another target in over here because we got support right over there, and then price comes down and goes like this, and price comes in and breaks down our beautiful trend lines and comes in here, and they're like, yeah, see, told you. That's someone who either doesn't trade or is a losing trader. Anyone who's taking profits that soon, I know that they are not a profitable trader. You can't be profitable in the markets taking profits too soon. Now, I'm assuming that you are not trading off of any high frequency trading algorithm. And I'm assuming that you're not front running your clients' orders. If you were doing that, if you were some type of fund that was like had the ability from paying for like high speed data feeds onto the exchange, and then you could do that. You're not able to do that, obviously. So rethink what you're doing. Is it much better? Price comes into this first target area, moving your stop loss to break even, and then pushing your trade. And that means that you could get stopped out. But are you comfortable with taking a very small win and getting stopped out? You better be, because that's the only way you're going to make it. And then you move your stop loss to break even, and then this one pulls down over here. All right, now get ready to take some profit. Maybe even take a small piece off over here. Maybe take 15% of your overall position off and then continue to push it, maybe even tightening up your stop loss and understanding that a lot of them are going to go back and get stopped out again. And that you have to have the fortitude to have enough trades until you get those ones that actually give you the majority of your profits. That's what I'm trying to do, is I'm trying to get you to think about the markets in a whole new light and to see them in a whole new light, to trade smarter and to be able to consistently profit for them. It's an education that takes time. I hope you commit to being here with me and over, let's just call it over this next year, making sure that you're really able to sharpen your skills. I'm willing to commit if you're willing to commit. And if you are and you haven't already, do go ahead and subscribe to the channel. Everyone, have a beautiful day. Thank you, Cloud. Really appreciate the sharing of the love. It really helps when you hit the like button. It really helps the channel with the Google algorithm, and it's greatly appreciated by myself. Thank you for doing that. Thank you, Craig, so much for jumping over here. Sean, that's good. I embrace the other side. So I disagree about there being plenty of liquidity. There may be liquidity in the US, but the rest of the world is starving for dollars. That's why dollars keep moving higher. The Euro curve is so. First of all, Sean, I with the greatest sincerity welcome not only
not because it disagrees, but your view, right? And I think in the past, one of my weaknesses has not been paying attention enough to all views. I think I've gotten a lot better at that. Because I made it a point to change. And that's the thing. I'm always looking to do better, and I'm always looking to find what my weaknesses are and improve on them first. I mean, I could take my strengths and continue to sharpen them, and that's one thing, but you'll make more progress by looking at your weaknesses. So as far as the euro dollar, the only person I know that really has offered very much information since for me has been what's his name from the Eurodollar University, Mr. X, we'll call him. I don't know, I forget his name, Jeff Snyder. And the thing is, though, listen, first of all, I've never been able to even listen through any type of session of Jeff's because it's very complicated. And when things are very complicated or someone can't take something that's very complicated and simplify it down so that it's attainable and understandable, I don't know. For me, it's a warning sign. But a bigger warning sign was over here on CTM. I was like, the Fed just expanded their balance sheet by $4.1 trillion is running quantitative easing right away in March 2020 into first week of April. And I'm like, that's uber asset inflationary. You cannot eat, and then into April, you cannot even sell any asset. You're forbidding from hitting the sell button. I know we just made a bunch of money off the sell side. I know that we crushed it. I came out of like from selling the S&P for like over a decade and started selling the S&Ps again. And the Jeff said that that's deflationary, right? Jeff was adamant that that's deflationary and the euro dollar and that was not deflationary, right? So again, that's a hard one, but when you say that you got to worry about the US and there's a shortage of dollars out there, so I look around, right? And I go over to FX and I look, Sean, and I look at the DXY, it's so strong. So I look at the euro, it's so weak. Well, the euro makes up 57% of that index. All right. So the DXY is basically an inverted euro US dollar. Yeah. Is that true, Jordan? If I go ahead and I pull up the euro, and is there an inverse correlation between the two? Oh my goodness. Look at that. Wait, the DXY is the inverted euro US dollar? Well, not just that. There's more to it. It's actually the next biggest component is the Japanese yen. And the Japanese yen you could see has been very weak, right? So, the two biggest components of the DXY are the yen and the euro. Those are both energy insufficient and they're getting obliterated. Yep, that is true. Well, it's got to be different. Pull up the peso, Jordan. Pull up the Mexican peso, right? And I go back and I remember when actually there was a liquidity crisis, a dollar shortage. This over here is the dollar shortages across the world. The Federal Reserve had to open up direct swap lines to central banks in order to get them access to dollars. Well, is there a shortage of dollars out there? Huh. It's not just the euro. There's a whole host of other currencies that are not putting in any similar price action to when we had a dollar shortages in the system. There are no shortages of dollars. There's an abundance of dollars. So much that every day the Federal Reserve is paying $250 million of interest on dollars being parked there overnight because there's nowhere to put them. So, Sean, that's my pushback versus your pushback. And we'll see what happens and how that transforms. But that's all with the greatest love. And that is done with, let's say, intellectual integrity on both sides. I appreciate the discussion. Sean, go back and see what happened in 2020 when there was a shortage of dollars. Go look at what Jeff was saying in 2020 and then see how he got the next 2 years or if it's the same thing being repeated. And I think that's important, personally. Me too, Kevin. Great to be here with you all and look forward to learning with you all. Must always be open to new info. Biases are just invisible chains, and bars. So with the dollar sign, just once again, big shout out, my brother. I'm so proud of you, of your work, of your ingenuity, going ahead and reaching an amazing milestone, getting funded and then getting paid. Really proud of you, my brother. Good stuff over there. Do I expect most currencies to collapse eventually versus the US dollar, leading to more Bitcoin adoption? If so, what currencies do you feel are the most vulnerable right now? JD, that's an amazing question. It's a great question. I want to talk about that, and I could give you the short answer right now, but I want to do a whole video off that, maybe even for tomorrow, right? So yes, I do subscribe to very strongly at this particular point. Hey JD, it's not that black and white. What do I mean by that? I could say very easily and adopt like dollar milkshake theory, and there's a lot to it. But I personally am also upon the belief that at certain times it's to be embraced. This was dollar milkshake theory all day long, and then as soon as things and factors changed, like opening up direct swap lines and printing of 42% of all dollars in existence. Like you didn't hear Brent like, okay, guys, that we just gave a master class on the workings of the financial system, and that all happened. But amazing, like new factors have been now added to the system, and I expect that there's going to be a significant cooling off of the dollar. That type of stuff happens, and you're just like, massive respect. But when that doesn't happen, and then for 2 years you just stay quiet, and then when the dollar starts gaining strength again, even though it's specifically versus two currencies, the Japanese yen and the euro, you're just like leaning back into like the milkshake slurping up. No. We're seeing weakness in the yen and euro. And we're seeing the weakness in the yen and euro for many reasons, but among them is because they're having an energy crisis. Now, Japan just did this week say that they're going to revert back to nuclear power. So that's like a check mark in Japan's camp. So at this particular point in time, I would imagine between the two, you'll probably start seeing, or we'll probably start seeing the yen begin over time here to revert back and strengthen versus the euro. Because that's like a check mark over. Now, is it possible Europe does the same in the future ahead? I certainly hope so. And then if they do, we have a changing dynamic. Okay. Now, I think it's really important to understand the dynamics of the financial system because it's a dollar debt-based system, and all these countries have been indebted by the IMF into slavery by building useless bridges. By the way, China's doing the same thing right now. I was just in Croatia, and they have a beautiful brand new bridge. It looks amazing with a brand new highway, and the highway is absolutely gorgeous, and it has tunnels through rocks, and it's built so well. It's amazing. And I was like, well, wow, that's beautiful. Who paid for this? How did Croatia pay for this? Oh, they didn't. The Chinese gave it to us. The Chinese gave it to you. Yeah, well, no, they built it for us, but we have to pay them back. So the same way that you saw the world indebted in dollars, now you're starting to see Belt and Belt. Why am I saying that wrong? Well, whatever. What is it called? The Belt and what? But the Chinese are indebting through infrastructure a large portion of the world right now for the potential trade Belt and Road Initiative. Thank you, Baron. And, that is not going to go ahead and say, okay, the dollar, which is the reserve world currency, is all of a sudden going to implode and the yuan is going to take over. But if the dollar had 70% of all trade, probably in the next couple of years, it'll have 58%. It's still a lot of dollars. And most importantly, that dollars is held in debt, and the interest on the debt is what makes the dollars so necessary. So people need to pay back that debt. They need dollars to pay back that debt. So the dollar's entrenched. Yeah. Now you have people out there that are just infinitely more intelligent and educated than myself in the markets, like Stanley Druckenmiller. And his view is that we're going to be seeing the dollar over the next, call it 5 years, come off massively.
His view is also that oil is going to come off massively, and that's because of the quote unquote clean energy and initiative. Now, I don't agree with the oil one at all. So I take a contrary opinion. I don't know where I stand with the dollar and what happens next. It's possible. Another thing that's also important to answer that question, JD, is that you might have potentially here as yields are rising in the U.S. that puts pressures on the Bank of Japan, where they're going to come in and need to defend their yield curve, and that means printing more Japanese yen to do it. Now, there could, and by the way, we've seen some really good content lately about the changing nature of Japan. Ever since their Prime Minister Abe was assassinated, and it looks like they are embracing a drastic change ever since World War II, and potentially remilitarizing. And it is possible that it sounds like a conspiracy theory, and probably is. We don't know. But it is possible that what will happen as yields rise in the U.S. and puts pressure on Japan, that the U.S., as we saw recently, acknowledge that they have the ability to hold foreign securities on their balance sheet. So you might see the U.S. print dollars, right? And they might buy yen with those dollars in order to defend the Japanese bank's yield curve. And if that's happening, that's going to take that strong dollar, which is definitely not good for the world. And the Federal Reserve is not really here to only, even if they tell you what their mandates are, they're not looking out for the world, for the U.S. They're looking out also for the world. They might come in and print dollars. You'll see the balance sheet expanding if that's happening. Watch out for that, because they're not going to tell you, hey, we're going to print dollars to buy yen to defend the yield curve over in Japan. But that might happen. So we don't know, as far as that question, JD, what is going to be happening going forward, because there's lots of moving pieces. Now, as far as leading to more Bitcoin adoption, that's my main signal when we talk about Bitcoin, is the adoption of Bitcoin, and how Bitcoin is undergoing an S-curve, and how in that S-curve, we're currently in the early adopters phase. Right now, we're trying to jump that chasm into the out of facing reality into the ultimate market opportunity. And assuming adoption continues, and it looks to be that adoption is continuing, that's the bullish case for Bitcoin right there. Now, I think when you see things like people seeing inflation being like so present in their lives, that even my mom is finally yesterday talking about it. Like, and at that point, a lot of people who didn't own any Bitcoin, and when I talk about a lot of people, I see some people refer to Bitcoin as the boomer coin. First of all, I mean, I don't know. I don't like straw man attacks. I don't no, not straw man. Anyway, I know my weakness is the word's not gonna come to me right now. But the whole maxi thing, as a way to Vitalik introduced as a way to defend Ethereum, or now trying with Mountain Men, and then what were we even talking about? How that all was related? I have no idea. So anyway, I lost it. I had something important to share, but I just lost it. I'll give it a second in case it comes back. Mountain Initiative. Hard times, unprecedented times call for great things. The greatest thing that we could do is get in here and put the work in together, right? To rise up. We did that already. Last time CTM was public, on the public side for an extended period of time, we taught a generation TA and how to profit from the markets. What we're doing now, the journey we've just begun, is going to be infinitely more better. Infinitely more better. That's my Mexican side, mas bueno. Either which way,
Boomer coin. Yeah. So, when people, instead of attacking Bitcoin itself, when you then like revert towards verbal attacks, that's a sign of weakness. But let's talk about boomers, and boomers actually hold the majority of the wealth inside the United States, and the wealth inside the United States worldwide is bar none. And the truth is that, these boomers, they're not attracted towards like whatever. They are attracted towards Bitcoin because Bitcoin has been around long enough inside pop culture that, like, for whatever reason, it's become sticky. So when they see Bitcoin at $20,000, they're like, "You're telling me I could buy a whole Bitcoin for $20,000?" And they go buy a Bitcoin for $20,000. So it's a lot. So we're having a new wave of adoption taking place. And it's not most of the people you see out there on the Twitter who have been on the Twitter and live in the Twitter bubble, and which is great because the amount of knowledge out there is that continues to grow exponentially. I think it really is a huge asset. But at the same time, not everyone has that same situation that you live within in your reality. And a lot of people, a lot of us plebs have been out there and dollar cost averaging for like as long as you can remember, and you don't have a large amount of capital on the side at this point to deploy and put to work. But other people who don't have even a position, and a lot of them boomers who do have a significant amount of savings, they do. And when they see the opportunity, those no coiners just became Bitcoiners. And that's a new wave of adoption that's happening right now in this bear market. I don't know what's going on with wallet addresses as they're shooting through the roof. It doesn't add up, but I'm going to leave that off as something. There's a lot I don't know, right? So the penny is the boomer coin. I mean, that's a tough one. Target audience. This is a good one to talk about over here. We'll keep going, I guess. The oil will trend down as solar and battery gain acceptance, right? But how much carbon do you need to make a solar panel or to make a battery? That's all made with carbon. So I'm not sure about, almost everything is made with carbon. As it stands now, a solar generated system is powerful enough to run air conditioning 5 times. Yeah, I got one. I'm all about it. I'm embracing it. I have a solar generator, and I'm so grateful for it because I think it's great asset to have. But I'm not. I also understand the carbon it took to create that solar generator and its panels, right? So I'm not sure. So petrodollar is almost completely dead with Saudi now selling oil for gold and other countries. Right. So as far is Saudi Arabia selling oil for gold yet? I know that they are building gold refineries in the kingdom. That signal right there. Why would they not use Switzerland's? What's breaking down? What different dynamic is changing? And you know what? Look, Baron, it brings back to gold. I'm always bullish on the shiny stuff in so much as I believe it's going to be revalued one day. I do believe that we're going to see it revalued one day. But right now, it's hard to put money to work there. I hope you already have that position. I know I've been holding mine for over a decade, and it hasn't held its purchasing power. But I believe in the long run, it's worth the allocation, and it's worth the insurance. But we are seeing a massive breakdown forced upon by the West. The West went ahead and they sped up the de-dollarization. And by the way, I was able to like in 2019 when I would have these de-dollarization conversations, people like there was massive pushback. People were not able to have those conversations. 4 years later, it's a given. It's happening, right? But it was when the EU and the United States went ahead and confiscated all of the euros and dollars from the Central Bank of Russia. At that point, they just like it seems like self-destruction. It's either really poor planning or it's really controlled demolition of the current. I don't know, but I think it's all complicated. So I'm glad for all these views that are being pointed out so that we get to consider them. All right. All right, everyone. Have a beautiful day. Thanks for being here. If on the way out, if you haven't yet, if you're on a mobile phone, please go ahead and take a moment, smash the like button. And if you're new here, welcome. Everyone, have a beautiful day. I'll talk to you again tomorrow. Jackson Hole.